Hello and welcome back to Principles of Accounting 1, Spring 2024. We are already in week 11. Can you all believe that? The time is going by, just as Sam was mentioning earlier. It seems like these weeks are just kind of cruising by, and we're already getting toward the end. Um, so it's quite impressive, yeah. So a couple of things I want you to note is today's date is 3/26. Okay, this course ends on 4/26. All right. What that means is we have exactly 1 month to get everything done. All right, including the final exam. So keep that date in mind. Now remember, some of you like to work ahead, and that's totally cool. If you want to work ahead, you're more than welcome to. I'm not going to stop you. Everything's open, okay? So just some food for thought, just in case you like to work ahead and you don't want to wait until the last week of the course to get everything in. So just think about that. Yeah. A couple of things also to note. Last week we talked about property, plant, and equipment. And we talked about depreciation and all that fun stuff, right? I also want to point out the hypothesis annotations. Don't worry if it says late on those, okay? I know it's not late. Y'all were not late, okay? It's just the way that it's set up in the grade book. Okay, there's hypothesis. And it's none of it's automatically graded. I have to grade everything. And so don't worry if you see the word late in the grade book. It's okay. It's all right. I know it wasn't late. So I just wanted you to be aware of that. So if you see it says late, but it's graded, don't worry about it. All right. Also important to note with a hypothesis, you're required to make two annotations and two peer annotations as well. Yeah, so a total of 4. So if you got less than a full score, that's because you maybe forgot to do some of that stuff. Yeah. So it's okay. Just be very aware of this. Okay. Uh, let's proceed to this week, which is a really fun and exciting conversation on payroll and current liabilities. Uh, Payroll accounting is pretty fun. All right. So if you are working in human resources, you might find this conversation to be enlightening. And also, if you're working and you get a pay stub and you're trying to figure out, man, how do they calculate some of these things like the taxes and whatever's, I'm going to show you how it works. All right, so you'll totally understand not only your own paycheck, but you'll also understand what it's like in human resources to go through these types of calculations. So it'll be a fun conversation. For this week, there's a discussion board, which I see some of you are already actively engaged in, so thank you for that. I see Maria, as always, is working ahead, and I do appreciate that, and a very nice post here, Maria, so thank you. But yeah, continue to do that. And then, of course, we have the quiz for this chapter. So let's go ahead and jump into the conversation on current liabilities and payroll. Okay, I'm going to talk about the current liabilities first, and then we'll jump into the payroll conversation. And then, of course, we'll end the class with a ratio or two just to keep things lively, because I know how much you love them. Okay, so on the balance sheet, what do we have? Who can tell me? Who can tell me? Go ahead, unmute your microphone and tell me on the balance sheet. What are the 3 categories on the balance sheet? Can anyone remind us of this? Marlon, I see your hand. Go for it, Marlon.
They are assets, liabilities, and equity.
You got it, Marlon. That's 100% correct. On the balance sheet, we have assets, liabilities, and equity. And it's in that order, right? On the left side, we got all of our assets. On the right side, we got our liabilities, and then we have our equity. That's because it matches the accounting equation, right? The accounting equation, as you remember, is assets equals liabilities plus equity, right? That's the idea here, is that your total assets equal your total liabilities plus equity. Right? That's why we call it the balance sheet. They balance. You see what I'm saying? And it shows the balances of all your accounts. Now, also on the balance sheet, you may recall that we also have what's called a classified balance sheet. And classification helps us to identify if something is current or long term. Under current assets, we have things like cash, accounts receivable, inventory, and maybe something like a prepaid expense. Those are your current assets. Current means less than 1 year. We also have long term assets like property, plant, and equipment. That stuff we talked about last week. On the liability side of the balance sheet, we have current liabilities and long term liabilities. Just as the name implies, current means it's due within 1 year or less. Okay, it's due because it's a liability. We got to pay liabilities. So it's current if it's due within 1 year or less. Long term liabilities, on the other hand, mean that we have more than 1 year to pay on them. A couple of examples. Current liabilities would include things like accounts payable, payroll taxes payable, taxes payable, income tax payable, sales tax payable. Notice how they all end with payable, right? We also have an account called the current portion of long-term debt, which is, as the name implies, the current portion, 12 months, of a long-term debt. All right. So those are examples of current liabilities. And then we have our long-term liabilities. This would be things like a mortgage, a long-term lease obligation, um, payments on property, plant, and equipment, long-term, vehicle payment, long-term, greater than 1 year. So just that helps to give you an idea as we're talking about liabilities. So a liability is anything that the business owes to someone else. A liability is anything the business owes to someone else. It's usually from receiving like a bill or some type of other obligation that we have to pay as a result of past transactions. Yeah, that's what it is, right? If it's already happened, it's due because it already happened. If it hasn't happened yet, it's due in the future. That's called a prepaid expense. Okay. As I had mentioned, two classifications for liabilities. Current means it's due within 1 year. Long term means it's due greater than 1 year. Yep. That's the simple part about it. Current liabilities would be things like accounts payable, wages payable, taxes payable, unearned revenue, short-term notes payable, due within 1 year. Yeah? Usually much less than that. And then we have long-term liabilities, greater than 1 year. Lease obligations greater than a year. Property, plant, and equipment payments greater than 1 year. Yep. Long-term loans and bonds. greater than 1 year. That's just some examples. This kind of shows you, this slide here, shows you the current and long-term liabilities from a couple of well-known companies. The percentages show us what the percentage of their assets that they owe to someone else. Okay? Now you can see here, a couple of these companies get pretty high, right? 74% for Dick's Sporting Goods, 69% for Bowl America. For me, when I invest in a company or I'm looking at the company's financial health, I don't like to see current liabilities super high. That makes me nervous as an investor. Why? Because it might indicate that the company is struggling to pay their current debt. Yeah, that's concerning to me when a company gets in that type of position. So, and I would normally calculate something like the current ratio to give me an idea. We'll talk more about those. Sometimes you get a bill in the mail and it's not always clear. It's sometimes unclear as to who to pay it to. What do I mean by that? You receive a bill in the mail, and let's say it's from, I don't know, WSSC. Okay. And you're like, oh, who do I pay it to? And then it says, send it to Department of Public Works. Right? Well, it came from someone else. So how do you know how to pay? So sometimes that could be uncertain. So it's really important for you to make sure that when you're entering a current liability, like a bill that you received, into your accounting software, like QuickBooks, that you're accurately entering who it's being paid to, right? So sometimes reading that bill is really important for that type of information. And they usually tell you who to pay it to. The second unknown in liabilities could be when to pay it. Well, I can hear you now saying, oh, Dr. B, I know when to pay my bills. Yeah, but do you? Here's what I mean by this. You know that your rent or your mortgage is due on the first of every month, typically. It's usually due on the first or the same day of every single month. And you usually receive your utility bills, and they're usually due the same day every single month. So hopefully those shouldn't be surprises to you. But let's say you have a business and you receive an invoice from a vendor for some merchandise that you bought, okay, and you're going to resell it. That's your business. Let's say you're in the clothing business, all right? So you buy clothing from a vendor and then you resell it online or whatever. Sometimes there could be uncertain when to pay that invoice. Now, why, you might wonder. Well, remember we talked about this kind of. We talked about 210 net 30. Do you remember that? We received a bill from our vendor and it says credit terms 210 net 30. Well, that could create some uncertainty. I could pay it in the first 10 days and receive a 2% discount, or otherwise it's due in 30 days from the date of the invoice. Right? So that could be uncertain of when to pay. Which leads me into the next item, which is uncertain of how much to pay. Okay. In that situation, we got offered the possibility of a discount. And so, how much do I pay? Do I pay the full amount? Or do I pay it minus the discount if I pay it in that first 10 days? Do you see what I'm saying here? So, uncertainty of when to pay and uncertainty of how much to pay are real situations when it comes to calculating your liability, right? So, things to think about. So it's important for us to know what we're paying. I mean, uh, you'd be surprised. I've had clients that sometimes didn't know that they had certain bills to pay. And it's just like, oh, that's scary. Like sales tax, for example, it's not always clear about sales tax. So let's say you have an online business. In your business, you have a distributor you purchase goods from and you house them somewhere, maybe in your house or in a warehouse or whatever, and then you sell them online. So you go to the post office or wherever, you ship it out, and it goes to a customer in another state. Okay? Here's the thing when you sell online the sales tax gets remitted to whatever state the customer is in. Yeah. Okay. So it could get confusing. You know what I mean? So you got to be real careful if you're selling online. All right. Let's say you're selling stuff on Amazon or eBay or you have your own retail store online or whatever, or you're selling stuff on Etsy or any of these online marketplaces. You got to be real careful because when it comes to sales taxes, the sales tax gets paid to whatever state that customer's in, not in DC. Do you see what I'm saying? So be very, very careful when it comes to sales tax. That's the trouble that my client got into. So a couple known liabilities. We know we have to pay accounts payable. These are daily bills that the company receives based off of our operations. We should know that we have to pay sales tax, and that's based off of the stuff we're selling and where we're selling it. Right? You have to pay taxes. Yep. Unearned revenue. We received payment from our customer, but we have not yet delivered the good or performed the service. Notes payable. We took out a loan or we have an agreement with our vendor for a note payable. You should know that you have that. Payroll obligations. If you have employees, you need to be withholding taxes for your employee. So you take the taxes out of your employee's payroll check and you have to remit those taxes to the respective tax agencies, okay? That's a really important thing to know. And then, of course, we have multiple period known liabilities. An example of this will be a long term loan. We make the same payment on the same day every single month for many, many years. Okay, those are known liabilities. And we're going to walk through these, all right? Here we go. First one, sales tax is payable. Home Depot sold some materials to a customer for $6,000 that are subject to a 5% sales tax. Okay. So the customer pays Home Depot $6,300. How did we figure out that the customer's paying $6,300 to Home Depot? Well, this is pretty straightforward because 5% times $6,000 is $300. Okay, so the total of the customer's bill would be $6,300. On Home Depot's side, we debit cash, we're Home Depot now. We debit cash $6,300. We credit sales $6,000 and we credit sales tax payable $300. Now you might be thinking, Dr. B, why don't we just credit sales $6,300? No, you can't do that because the sales tax is not a part of your sales. You have to pay that sales tax to the tax agency. in business, when it comes to taxes, we withhold the taxes from our sales. And then every quarter, should be every quarter, you pay that sales tax to your respective state tax agency. You see? That's how it works. The next example, unearned revenue. Oh, Selena Gomez. I love Selena Gomez. Okay, Selena. She's crushing it, all right? Sells $900,000 in tickets for 3 concerts. I'm sure it's way more than that, but this is just to keep things easy. All right. So, June 30th, she sold $900,000 in concert tickets. On June 30th, in her accounting, she debits cash for $900,000 and credits unearned ticket revenue $900,000. It's unearned because she has not yet performed the concerts. She hasn't delivered the service yet. You see what I'm saying? That's why it's unearned revenue. Then she starts performing her concerts. Okay, she had one October 31, and then 2 more thereafter. We'll say November 1, November 2. All right? So on October 31, and she does this for all the concerts after she performs them, debit unearned ticket revenue $300,000 and credit ticket revenue $300,000. How did we figure out $300,000? We took the total from all 3 concerts, $900,000, and divided by 3 to get $300,000. Okay, so that's unearned revenue. Now, I want to show you a couple of more of those liabilities examples, but we're going to break them down a little bit further. I want to show you the short-term notes payable. And we've talked briefly about the short-term notes payable. Remember, there's kind of 2 reasons why it happens. One is we borrowed money from a bank. Okay. And the other is we're paying a vendor on a short-term note payable. Yep. Either are possibilities for this to happen. But it's a written promise to pay specified amount on a stated future date within 1 year. Remember the promissory note. I think we talked about this. Of course, it bears interest. It's a note. There's going to be interest involved. And again, it could either be because of an account payable that was converted into a note payable, or it could be because we borrowed a short-term loan from the bank. So let's roll through an example of this. Here we have an example of an account payable that was converted into a note payable. We made a deal with our vendor because we got a little past due with our vendor, and we're like, oh, I'll make you a deal. I'll get you caught up, okay? And the way I'm going to do that is I'll give you a little cash now, and the rest of it you can convert into a note payable. The vendor agrees, they sign a promissory note, and this is what it looks like. Our vendor, Bradley Company, Bradley Company, asked our vendor McGraw to accept $100 cash now and a 60-day 12% $500 note payable to replace our existing $600 note account payable. Okay, so the first thing we do is we convert the account payable into a note payable and recognize the $100 in cash we're paying up front. So we debit accounts payable for our vendor $600. We credit the cash $100 because we're paying the $100 up front, and the remaining balance we we create a new notes payable for our vendor McGraw of $500. Now, notice it's 12%, 60 days. So August 23, and then here we go, 60 days later, October 22nd. Now we're paying our note payable to our vendor. We debit notes payable 500. We debit interest expense $10, and we credit cash 510. How did we figure out the $10 of interest expense? We took the face value 500 times the interest rate 12% times time. Now remember this part, okay? I'm pretty sure we talked about this before, but it's the number of days divided by 360. Okay? Number of days, in this case is 60 days, divided by 360. Now you might be asking, Dr. B, why 360 and not 365? That is because here in the United States, we have 360 banking days in a year. Okay, that's why 360. So that's where the $10 comes from. So that's the example of we made a deal with our vendor, converted it from an account payable to a note payable. Now let's look at this in another way. Let's say that we are borrowing money from a bank. Okay, we're borrowing $2,000 from the bank. All right, and we're going to use that money to pay our vendor. Right? Yeah, nothing wrong with that. So we're borrowing $2,000 from the bank at 12% interest. It's a 60-day loan, so it's a note payable. So we debit cash $2,000, credit notes payable $2,000. I'm going to use that money to pay my vendor, but also I need to recognize the interest expense during that time. Right? So I'm going to debit notes payable $2,000, debit interest expense $40, and credit cash $2,040. Remember, to calculate interest expense, we take the face value times the interest rate times time, number of days over 360. Do that part first, the parentheses. Remember your order of operations. Parentheses part first. Face value times interest rate times time. In this example, $40. You see? It works the same way. It really works the same way. Okay. Now, what happens if this loan goes more than one period? What I mean by that is, let's say we took the loan out on December 1st or December 15th, we'll say, 16th. We borrowed it on December 16th, and it's for 60 days. Well, that would take us into the next year. Okay, so we need to recognize the interest expense incurred in each respective time period. So if I borrowed money on December 16, on December 31, I need to recognize the amount of interest for that 15 days. You know what I mean? And then the remaining 45 days would be attributed to the next accounting period. You see? Remember the matching principle. So here's the example. December 16, we borrowed $2,000 at 12% interest for 60 days. At the end of the year, end of the calendar year, I debit interest expense and I credit interest payable. In this example, $10. How do we figure it was $10? We took the face value times the interest rate times time. Now, here's the important thing about the time. Notice the time of the loan initiated December 16 to the end of the year, December 31. That's 15 days. So 15 over 360. All right, that's how we got $10. And then on February 14th, we repaid the loan to the bank. But I need to make sure that I account for my remaining interest and for the interest I've already accrued. So here's the way it works. We debit interest expense, $30. How do we get 30? The face value times 12% times 45 days that was remaining over 360. That's how we got 30. Debit interest payable. That's from the previous accounting period. $10. Debit notes payable, $2,000. We credit cash, $2,040 is the total amount we're paying to the bank. All right. Okay. Any questions on those types of liabilities before we start moving into payroll? Doing okay? All right. Okay. Remember, if you have questions, just unmute your mic and ask your question, or type it in the chat or whatever. All right. Let's move into payroll. It is really important in business to track your payroll. All right. You got to know how much to pay your employee. You got to know how much taxes to withhold for their taxes, benefits, etc. Okay? So there's a lot of deductions that you need to be aware of. Okay, payroll liabilities. We have to pay our employee. That's a liability. We have to withhold our employees' taxes and remit those taxes to the tax agencies. That's a liability. We have to withhold employee benefits, and then eventually, when the employee takes those benefits, we have to pay it out. That's a liability. Payroll taxes, liability. You see? Let me show you what your paycheck looks like and how it's calculated. And a nice graph. I like graphs. Okay, here we go. Take a look here. Gross pay. The gross pay is the total compensation that you would have earned before any deductions. Okay, gross pay. It's the total compensation that the employee earns before any deductions. That's gross pay. That's what the word gross means. It means the larger sum. That's what the word gross means. Okay, gross pay before deductions. Now let's take a look at all of the deductions. Social Security, Medicare, state and local, Social Security, Medicare, federal income tax, state and local income taxes, if applicable, voluntary deductions. You subtract all that stuff out to ultimately get to net pay. The net is whatever's left over after all the deductions, usually a lot smaller than the gross, unfortunately. So let's talk about these individually. Social Security taxes. Oh, I'm sorry. Let me start with voluntary deductions. These come before everything else. Here's why. Because when we take out voluntary deductions like contributions that you made to your retirement plan, your 401k, 403b, whatever's, that's part of voluntary deductions. All right. We take that out before taxes. Before taxes. So any retirement contributions that you make, any um, charitable contributions that you make, or even some required deductions that you're required to make, like child support or childcare, or or a health savings account. All of those deductions come out before taxes. Okay, why? Because you don't pay taxes on that stuff. You will eventually down the road when you use it. You see, but in terms of your paycheck, voluntary deductions, those come out before the taxes because you don't pay taxes on that stuff. You see? That's usually why you see it first on your pay stub. Now let's talk about the other stuff. Social Security taxes. Social Security taxes, which is a part of the Federal Insurance Contributions Act, requires that both employees and employers contribute to the employee's Social Security fund. Social Security is like a form of a required government funded, well, it's not government funded. Your employers are funding it, and so are you. It's a required, we'll call it retirement account, for lack of a better word. That's what Social Security is. The idea here is that when you get older and you're no longer working, you can collect Social Security. Yep. Both the employee and the employer contribute the same amount every pay period by law. Yep. And I'll show you what that looks like here in a little bit. Medicare. Medicare is, we'll call it, I'm going to try to be nice about this, a required medical insurance program for when you get older. It's kind of what it is. Required medical insurance program for when you get older. Right? So when you retire, instead of having employee health insurance, your health insurance will be through the government called Medicare. Yeah, that's the idea. You pay into it, and so does your employer. It's a match. Yeah. And then we got the taxes. Federal income tax that you pay, not the employer. You pay to the government, to the IRS, and then, well, I mean, your employer collects it from you and then pays it on your behalf. That's what I meant to say. And then we have state, DC, local, city income taxes. So, and then it gets your net pay. So that's how that works. I'm going to discuss these a little bit further. Let's start with the Social Security and Medicare. So as I mentioned, Social Security is kind of like a forced um, retirement account on your behalf. As of 2020, the rate for Social Security was 6.2%. of the first $137,700 earned in the year. I think it's around the same percentage today. So that's probably about right. 6.2% for Social Security. So the way that works, as I mentioned, is that 6.2% of your paycheck is withheld and remitted to Social Security. And then your employer also contributes as well. For the Medicare, 1.45% of your paycheck comes out for Medicare. And it's all remitted to the IRS. That's who figures all that stuff out, allegedly. Uh, Employee income tax, federal and state and local. The percentages are based off of your earning rates. As you probably know by now, the IRS has what they call tax brackets, and they publish those every year. And it tells you the percentages that you would fall within. And then of course you have allowances and things like that. So if you have children or other dependents, you can declare those as allowances. And then of course if you're married, if regardless of whether you're filing separate or joint, that puts you into a different bracket as well. So things to be aware of, yeah. So we pay both federal, state, and local. Sometimes the local doesn't. The local part is based off of where you live. So, like for example, some parts of Montgomery County in Maryland uh, might require a local tax. Yeah, it's like the city tax. That's the way to think about it. Not all jurisdictions do it. Okay, the voluntary deductions, and I'd mentioned these things before: charitable giving, medical life insurance premiums, retirement contributions, union dues. These are voluntarily, okay, but they're taken out before the taxes. Yeah, because these things don't get taxed. They get taxed when you withdraw from the retirement or when you use them. Here is an example of the type of journal entry that we make for each employee. Okay. Well, really, we do it in a lump sum, but this is what it looked like for one employee. So here we have an employee who earns $2,000 per month. Okay. So at the end of the month, this is what it looks like for this one employee. Debit salaries expense $2,000. Then we credit all of the deductions one by one. Credit Social Security at 6.2%, which is 124. 124, 2,000 times 6.2% is 124. Medicare, 1.45 times 2,000 is $29. Employee income tax, 213. Medical insurance, 85. Union dues, 25. The net pay is what we call salaries payable. That's what we actually pay to the employee. Credit salaries payable, $1,524. And then when we actually write the check, we debit salaries payable and credit cash. Now, I'd mentioned that the employer also has to pay what we call a match. And they also have to pay federal and state unemployment taxes. So for the employer, the person who you work for. The employer matches your Social Security and your Medicare. So whatever you pay in Social Security and Medicare, the employer has to match that legally. Okay. The employer also separately pays unemployment taxes, both federal and state. The employee does not, the employer does. Okay, so the employer does not pay federal and state taxes like the employee does, but the employer pays federal and state unemployment tax. What this is if you ever become unemployed for whatever reason and you have the ability to declare unemployment, this is where that money comes from. This is how it's calculated. Yeah. Your employer is paying into it, and if you become unemployed for whatever reason, that's part of the benefit. Yep. Let me show you what it looks like. For the federal side, for the federal unemployment tax, the employer pays 6% on the first $7,000 of wages for each employee. And they receive a credit up to 5.4% for state unemployment taxes paid, which usually results in a net of 0.6% federal unemployment. Now, during the pandemic, when the federal government was issuing whatever the hell they called those checks, it came out of that fund. Okay. The state unemployment side. The state, and usually depends on what state you're in, but averages 5.4% of the first $7,000. Okay. And it goes every year, you see. So the longer you work for the employer, the more the employer is contributing into these funds in the event that you become unemployed. For no fault of your own. I got to put that in there. For my HR friends in the room, I got your back. All right. This is the journal entry that the employer side would make. Debit payroll tax expense, 273. Credit, Social Security, 6.2%, 124. Credit, Medicare taxes payable at 1.45%, that's $29. Credit, state unemployment taxes payable of 108. How 108? The employee gross pay was $2,000 times the 5.4% for the state. That's 108. For the federal, it's the gross pay times 0.6%. In this case, $12. See? Payroll is typically taken care of within the HR area. Okay, human resources. Human resources governs the policies and procedures. The accounting office, those are the people actually doing the calculations and remitting the taxes and the checks and all that stuff. Okay. But they usually also represent human resources, typically. 4 key areas of payroll that are usually separated and monitored. Employee hiring, part of HR. Payroll preparation, part of accounting. Timekeeping, That responsibility is controlled by the employee and monitored by HR. Payroll payment, that's taken care of by the accounting office. You see how it's all separated out. Checks and balances, real important in business. That's how I prevent fraud. Okay, so that's payroll. Any questions on payroll? We do okay? Payroll? All right, cool. Let's keep rolling. One of the other topics that I said I wanted to cover is what we call multi-period known liabilities. These are liabilities that go into more than one accounting period. Okay. This can be either short term or long term, but they're multiple periods, you see. Uh, unearned revenue from magazine subscriptions for longer than one accounting period. Portion of that is earned revenue. And the rest of it is unearned. Okay, here's the way to think about this. You receive a magazine in the mail. There's 12 of them in the series. That first magazine that they sent you, that's earned revenue. The rest of it's unearned until they deliver that magazine for 12 months. Okay. Notes payable oftentimes goes greater than one accounting period. A 3-year loan note would be classified as a current liability for the first year and long-term liability for the 2 years thereafter. That's when I had mentioned that term that you may have not heard before, the current portion of long-term debt. The current portion of long-term debt. That's the actual account name. All right? The current portion shows on your balance sheet as a current liability. The current portion of long-term debt. It represents 12 months of the long-term debt. It's current because it's due within that 12 months. The remaining of it would be on the balance sheet as long-term debt under long-term asset liabilities. Okay, other liabilities. Warranties, bonuses, pensions, health care, vacation pay. These types of liabilities need to be estimated. Now, why do we estimate a liability? Because we don't know when the employee is going to take vacation. We don't know when the employee is going to retire. We don't know when the employee is going to need health care costs covered. We don't know when a customer is going to make a warranty claim on a product that we sold. So we have to reasonably estimate these things. You see? So I'm going to talk about that here in the next few slides. Healthcare and pension. Employers expense pensions or medical, dental, life, and disability insurance. Okay, these are benefits that the employer offers to the employees. We don't know when the employee is going to need these things, so we have to estimate based off of the employee's pay. You see? So here we have an example. Let's assume the employer agrees to pay the amount for medical insurance equal to $8,000. and contributes an additional 10% to the employee's gross salary to a retirement plan. All right, cool. Those are nice benefits. So here's how it looks. We debit employee benefits expense 20,000. How 20,000? 8,000 of it was for the medical insurance, and 10% of 120, which is 12,000, is for the employee's retirement program. So debit employee benefit expenses, credit the medical insurance payable, credit retirement program payable. It's estimated, you see, estimated. We do the same thing with things like vacation. We don't know when an employee is going to take vacation, so we need to estimate. How do we do it? Oftentimes, it's based off of what the employee earns with the expectation that they're going to take at least 2 weeks during a given year. Okay? We accrue time. We accrue it. Right? So as you work throughout the year, you might have a benefit from your employer that says, oh, you get 2 weeks off every year. Okay? But you have to go through that year to earn the full 2 weeks. Otherwise, you could take a couple days here and there. You know what I mean? So that's how it typically works. So here we have an employee that gets 2 weeks paid vacation every year. We debit vacation benefits expense for the employee, $3,200. Credit vacation benefits payable, $3,200. Then when the employee actually takes a few days off, we debit vacation benefits payable and we credit cash because it goes on to the employee's paycheck, you see. And then sometimes you get real lucky and you work for an employer that gives you bonuses. Professors don't get bonuses. I just want you to know that, okay? Let's assume that a bonus is paid to the employees, $10,000. That'll be shared by all. Oh, sorry. Sorry about that. Shared by all. Okay. I got excited there for a second. I'm like, oh, 10,000. That sounds nice. Oh, it's shared by all. Well, it's still nice. Okay, so we debit employee bonus expense, credit bonus payable. So that's how that works. I'd also mention warranties. Sometimes you might purchase something from a store and it comes with a warranty. Okay. Or maybe you bought a car, a vehicle, and it comes with a warranty. Okay. The warranty might be something like, a couple of years, 3 years, we'll say 3 years, up to 50,000 miles, parts and labor, or whatever, right? Okay, that's a typical type of car warranty you might get. Or let's say you bought a television, okay? Expensive television. Anything happens to it within the first year, the company will repair or replace it. Okay? Whatever. Things happen. So in order for the business to figure out the warranty expense, we got to estimate what percentage of customers are going to make a warranty claim. Yeah, typically. So that's usually how we figure it out. So let me show you an example. A vehicle. Okay. The dealership sells the vehicle for $16,000. This is obviously before inflation. I just want to point that out. The dealership sells the vehicle for $16,000 with a 1-year, 12,000 mile warranty. It's probably a used vehicle, is my guess. All right. Selling the vehicle for $16,000, 1 year, 12,000 mile warranty covering parts. Notice how it doesn't cover labor. Sorry. Based off of past experience, this at this dealership, the warranty expense will probably average 4% of the car's sales price. Okay, so 16,000 times 4%, that's $640. So for our estimate, we debit warranty expense 640 and credit estimated warranty liability. Now, in this case, it just so happens that something happened to that car. All right. Customer comes back. Oh, it needs a new, I don't know. I don't even know what it costs $200 these days. Something cheap broke. So, customer comes back. There's a repair, $200. We debit estimated warranty liability. They use that 200. And we credit parts inventory, 200. We took our existing inventory. It's just one of many types of these examples, yeah. Okay. And thinking about the warranty experience that we just walked through, for other liabilities, we got to think about the possibility of something happening. It's kind of like insurance, right? We all pay insurance for things: renter's insurance, homeowner's insurance, car insurance, pet insurance, health insurance, dental insurance, eye insurance. Did I miss anything? Umbrella insurance. We all pay these insurances, but most of the time we don't use it. Well, why not? Because nothing happens. I didn't get sick. My eyesight stayed the same. Um, Nothing happened to my house. Nothing happened to my car. So we pay the insurance every year, but we don't always use it, right? It's okay not to use it, by the way. It's actually probably good that you don't. It gives us peace of mind, right? It's important for us to figure out the probability of something happening, to figure out if that insurance is enough. You see? We call these contingent liabilities. Contingent liabilities. Uh, Examples: legal claims, debt guarantees, other contingencies like loss from insurance, government investigations, whatever. There's all kinds of possible things that could happen. So we call these contingent liabilities. And we have to estimate these kinds of things in business. We do it based off of probabilities. If the probability is remote, then we don't put anything in our disclosures. We don't even put a note for it. Okay. If an event is possible, like an insurance claim, it's possible, then I put it in my notes. Okay. And I might need to estimate it, but probably not if it's possible. If it's probable, like, yeah, I'm probably going to make a claim in the next year or two for anything, then we need to either estimate it or not estimate it. If we estimate it, we have to record its liability as an estimated expense. If we cannot estimate it, we just put it in our disclosures. You see? Examples of contingent liabilities: legal claims. Uh, if you're in the type of business that you might get sued, like you're a medical doctor, you might get sued. If you're a lawyer, you might get sued. If you're a dentist, you might get sued. You know, It's possible that any business could get sued. So we have to think about the potential legal claims in business and estimate if it's reasonable. Debt guarantees. This is where you, as a business owner, you might have to put up collateral for the business. That collateral is a guarantee against the debt. It might be your house, it might be your vehicle. It's called a debt guarantee. Other contingencies, environment would be things like environmental damage, tax assessments, insurance loss, government obligations. And of course, not everything's certain. So we can't guarantee something's going to happen in the future, nor can we prevent it. Call this uncertain. So when something's uncertain, we may or may not have to disclose it depending on the possibility of it happening. And as I mentioned, no class is complete without at least one ratio. And here's one. It's called the times interest earned ratio. And we use it to analyze our liabilities. It tells us about the company's ability to pay interest expense in the future. Okay? So we take income before interest expense and income taxes found toward the bottom of the income statement, divided by interest expense, also found on your income statement. And here's an example of that for a company. 2.5 times. That's good. That's good. I usually say anything over 1.5 is good. Anything below 1.5, not good. And just to kind of recap on the payroll conversation. There's a lot of forms, okay? And you might remember some of these forms when you were first hired. You had to fill out what's called a W-4. The W-4 tells the employer the number of withholdings, dependencies, etc. Right? That's called a W-4. And that gets filed with your human resources office. The company also has payroll reports. Every year, your employer sends you a W-2 that helps you for your annual taxes. IRS Form 940 or 941, depending on your situation. In terms of payroll, the employer tracks all payroll checks that get sent to the employees. The payroll register, it's a history of all of the checks sent out. And employee earnings reports, tells you where you are to current date. Just some examples of payroll reports, records, and procedures. And the last part I want to talk about is the corporate income taxes. So the employees, they have to pay income tax. Yeah, it comes out as a form of federal, state, local, Medicare, Medicaid, and the Social Security, right? On the company side, the company's got to pay taxes too, right? Based off of the company's earnings. So here's some adjusting entries, and here's what it looks like. We debit income tax expense, credit income taxes payable. Then we pay it, debit income tax payable, credit cash. And then this is an example of what we call a deferred liability. This is where we accrued additional income tax and haven't paid it yet. deferred liability. Okay, that, my friends, is the end of our discussion today on current liabilities and payroll. Are there any comments, questions, or concerns that you have about current liabilities and payroll? Or did we do an all right job here? Y'all good? You sure? I haven't been on mute this whole time, have I? I hope not. That would be terrible. Y'all seem so relaxed today. My goodness. Is it because it's Tuesday night? Seriously, are you all okay though? Yes, no, maybe? Somebody? Anyone? I'm going to assume yes. Sam, we good?
Yeah, we're good.
Okay. All right, cool. All right, just as a recap, for this week, we have a discussion board. Please, please, please try to get your initial post completed by Thursday night. Okay, Thursday night for your initial post. That'll allow just enough time for your classmates to get back and respond by Sunday night. Yeah. So do your absolute best. Thank you, Maria. Thank you, Anta, for both of you for contributing already. I sincerely appreciate that. Um, thank you, thank you. This is good. Good stuff. Okay, yeah, keep up the momentum, all right? So you got your discussion board, initial post by Thursday night, 2 responses by Sunday, and then you also have your quiz for this chapter. As always, if you ever need anything, you need help with something, you don't understand something, you can email me, call me, set up office hours. Whatever you need, I'm always here for you. You know that. Thank you all so much for your time today. I sincerely appreciate all of you and your hard work. Let's keep it going because we only got a few weeks left. We got less than a month remaining. Let's get it done. Thank you all so much for your time today. Appreciate all of you. Have a wonderful rest of your night. Thank you so much. Take care. Bye bye. Good night. Good night.